Thursday, June 29th, 2023, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at why gold is a boring commodity. Yes, we've had another one of these, this time not in the FT, but on Bloomberg.com. Before I start though, I'd like to go through some headlines that have, in my opinion, been quite important of late. And this just goes to show how everything is unraveling. And why is that? Well, because our monetary masters kept interest rates negative or near zero, or in real terms negative, for too long. They printed too much money, and it gave not just individuals, households, the wrong signals to borrow big mortgages, but also corporations, governments, of course. And today's headline is to do with Thames Water, which is the utility that we use for our water, at least where I am. And I think it provides a quarter of the water for England and Wales. So what's going on with Thames Water? Well, it was privatized a few decades ago, and then it went public, of course, in the stock market, and then it was bought by private equity groups. And private equity is a time bomb as well, in my opinion. Why? Well, because the only reason they're able to take over these companies is because they borrowed so cheaply, and now with interest rates going up, it looks like we, the taxpayer, are going to have to bail out this company. And I'm sure the directors and the executives of these private equity groups, they're going to be fine. Their wealth is going to be ring fenced, and we're going to end up holding the bag. So UK government looks at nationalizing Thames Water as crisis deepens. Ministers on standby to intervene in debt-laden business. There you go, a day after abrupt exit of CEO Sarah Bentley. So they've got 14 billion in debt. And I read that when they were privatized in 1989, I think, the government got just under £1 billion for it, and it had almost no debt. So here we are, over 30 years later, and 14 billion in debt. Am I saying that privatizing private companies are no good, that the government should own utilities like this? Not necessarily, because I think the way they run these companies and the way they're regulated is not any good either. But then we have to go to the crux of the matter, is that when governments and central banks manipulate the price of credit for so long, we don't have a free market, and we get stuff like that. And we're going to get a lot more of these problems elsewhere. Yes, last year we got problems in the defined benefit final salary pension system here in the UK. This is another accident, I guess, and it's going to happen. So what else is going on here that I thought was interesting in letting you know about? Well, I wanted to show you a story that shows that crime pays. Of course, not all the time. Only if you're connected to the District of Criminals, or Washington, D.C., or even the City of London, or Westminster, of course. We've seen that Boris Johnson bought a £4 million house recently on a salary of less than 200,000 as a politician. And now we see that Anthony Fauci, according to iSource News, Fauci buys exclusive 150-acre luxury retreat on the Potomac. Rumored $18.9 million price tag makes it the most expensive estate in the area. So I guess it pays to be a bureaucrat, longtime bureaucrat in the District of Criminals. So there you go. back to gold and the boring commodity. Well, many of you, of course, have heard about this editorial that I've talked about many, many times. Editorial from the FT, of course, that said that gold was pointless, and that it was pointless holding bullion, and that the pointlessness of that was continuing to sink in, going gold. And this editorial was written on April 16th, 2004, and at the time gold was struggling to get back above 400, which if you remember well, and probably many of you don't, you haven't been around as long as I have and follow gold as long, but 400 was always a key level back in the early 2000s, because it was an important level that we got up to in the late 80s, and we failed there a few times. 400 was like the 2000, I would say, of present day. And lo and behold, people who read this editorial and believed what the FT said, they're probably kicking themselves right now, because they could have done very well by just holding a boring commodity that's really easy to hold, right, in your hand. Especially in other currencies other than the dollar. I mean, in British pounds at the time, I think we were at 240 pounds an ounce. Now we're at 1,500, and we've been almost up to 1,700. And in my opinion, it's going to get even worse for the fiat currencies. So what am I trying to say here? We're going to go through the Bloomberg editorial in a minute. Well, I'm trying to say that a lot of people don't understand gold. This particular economist thinks gold is a boring commodity. He doesn't understand money, of course. He doesn't understand what happened also in the 70s. But let's go through it. And am I saying that this is a contrarian indicator? I think so. I think so. Of course, many people are going to read this on Bloomberg. And in 5-10 years time, they're going to regret not having bought gold, because they read this and said, well, yeah, it's a boring, it's just like any other asset, like he says. And is it any wonder? I saw a headline yesterday that OPEC has banned CNBC, Bloomberg, and the Wall Street Journal from its meeting. The journalists for these organizations can't attend it. Maybe OPEC is twigging on to Operation Mockingbird. And if you don't know what that is, Google it and look it up. I don't have time to talk about it. But any wonder? They're waking up the boys and girls from OPEC and OPEC Plus, of course, which includes Russia. So let's quickly get to this editorial. Gold is no longer a good hedge against bad times. The precious metal has become just another cyclical asset, no longer a useful harbinger of social and economic collapse. So we're going to go through this, and I'm going to tell you what I think the purpose of gold and why it's a good money to have, really, because that's what it is. Those who remember or read about the 1980s may consider the price of gold to be a highly dramatic variable. During the post-war Bretton Woods years, the price of gold was pegged at $34 an ounce. But after Richard Nixon severed the dollar's final link to gold in 1971, prices soared to more than $800 an ounce by 1980. Fortunes are made, gold bugs proliferated, and the price of the precious metal became a daily fascination. Many commentators consider the high price of gold to be a harbinger of disaster for both fiat currency and Western civilization. Well, 1970s, what happened to the price of gold? Yes, Nixon defaulted, of course, in 1971, August 15th. Price of gold went to $200 by the end of 1974. And then it dropped to just over $100 in 75. And it didn't really recover above that $200 level until I think 77, 78. So it wasn't all plain sailing. That's what I wanted to let you know. Tyler Cowen, of course, has not really looked carefully at what happened in the 70s. He just said it went from 35 to 800 and that's it. Even if it's trading around a record high of $2,000, these days gold is a little boring and likely to remain so for the foreseeable future. According to a new study from the National Bureau of Economic Research, gold prices have followed some fairly standard principles since at least 1990. To put it simply, gold prices decline when real interest rates rise. Well, we've had negative real rates for eons. And of course, these economists and even Wall Street and the City of London, they look at the tips and the expected rates, right? Which is BS, of course. That is because gold itself has zero direct yield. So at higher interest rates, the opportunity cost of holding gold goes up. In this regard, gold is like many other assets, including crypto, tech companies, and real estate. Don't quite get that because fiat currency notes or dollar bills, Bank of England notes, if they sit there and you don't lend it, they don't give you an interest either. Real estate gives you a rent. I'm not sure what this guy is talking about. The other thing I would say, it's been a really boring asset, hasn't it, since 2000? As you can see here, in all the major fiat currencies, gold has gone up 9.3% per annum. We've been lied to about currency debasement. And why? Well, as I've always said, because they equate 2% or 3% CPI or 1% CPI with something being good. But no, it's a tax against you and your currency. And even prior to 2020 and what's happened in the last year and a half or two, we all knew that things were going up in price. We had shrinkflation. It's nothing new. So that's what gold does. It's an honest indicator of currency debasement. And of course, this guy probably doesn't understand inflation anyway. Tyler Cowen, he probably thinks it's the CPI, right? So let's continue. There you go. A boring commodity. In a world of rising interest rates and slow economic growth, gold just doesn't hold much appeal. Well, it's the same thing in the 1970s, Mr. Cohen. Treasury rates and the Fed funds went from around 4 or 5% all the way to 15 and 20, and there was stagflation and gold did well. All I think is happening right now is a pause before the dollar and all other currencies crash versus gold. So let's continue here. The price of gold also goes up and down when demand for it as a major commodity goes up and down. So if, say, China becomes a major global economic power, the Chinese economy will need more gold, if only for its commodity uses, and then in turn will boost gold prices as it did starting in 2002. There's also sizable gold jewelry demand from India, so that country becomes wealthier. That too will boost demand for gold and thus its price. Again, he hasn't looked into the stock flow, the average stock to flow ratio, of gold, which is around 84 years. So supply and demand for jewelry, that's another fallacy about the gold price. The gold price is more related to the inflation of the currency, really. And that's what it's all about. We've been inflating the currency. And I think the Bernanke speech in 2002 was, for me, a great, not a signal that, you had to have gold and keep stacking it. That's what it's all about. He doesn't even cover the all the central bank buying that has been happening. The biggest central bank net gold buying in recorded data from the World Gold Council last year, and it's continuing this year. Under both mechanisms, gold is no longer a good hedge against bad times, as it correlates with both low interest rates and global economic growth. Gold becomes another cyclical economic asset that is a big part of the reason why gold prices are no longer followed so closely or seen as useful harbingers of social and economic collapse. Instead, it is perfectly fine to have a high or rising price of gold. Price of gold seemed so dramatic in the years surrounding 1980 because markets and prices had been suppressed for so long in the previous years. I guess he doesn't know about the current price suppression. So at that time, it was very hard to know what gold truly was worth because various prices had not been tested much in the markets and by market procedures for trial and error and value discovery. There is a broader lesson here, including perhaps for crypto. If governments wish to normalize an asset and its pricing, they will often do best with a dose of benign neglect and the simple passage of time. I'm going to stop here. I don't want to go on for too long. I'm going to put the link to this article under archive.ph, of course, because Bloomberg, you have to pay to read their articles, so you can read the whole thing. But I think this is just a very good contrarian indicator and gives us even more reason to hold on to gold when some bozo from, where is he from? George Mason University talks out of his ass, really, and I'm sorry to use that term, but basically that's what it is. So he finishes by saying, commentators on financial markets love to stress mysteries, speculative bubbles, and eventual crashes, but sometimes the actual truth is more mundane than that, and we see this even for gold prices. This is a bit of a shocking, contrarian idea, but a lot of the world, including the economic world, just makes plain sense. Let's enjoy that feeling while it lasts. So, yeah, gold is the anti-dollar. And what's the, anti-fiat dollar? And we've seen with the debt situation, that debt ceiling impasse earlier this year, that things are not going to get better. The debt held by the public is forecast to double to like almost 48 trillion by 2033. And that's not me saying it. That's the Congressional Budget Office. And of course, the fiat dollar is backed by government bonds. So the more you issue, the more the government borrows out of thin air, the more diluted that currency becomes. Yes, you could argue, oh, we're going to have economic growth, and that's going to write off the debt. But the economy needs to grow more than the debt. Do you really think the economy is going to double in size in the next 10 years? I doubt it, especially seeing that the only reason we're seeing positive GDP is because of deficit spending. So there you go. That's how I see it. And I told you I would say at the end what I think gold is really all about. Well, you saw it from the incrementum, a scorecard for gold for the last 23 years. And someone asked me yesterday about the manipulation. Can it keep going? Not forever. And why do they do it? Well, they do it to keep you out of gold because eventually the price will go a lot higher because it's a natural law because gold is money and the fiat dollar is the anti-money. And if you keep inflating the fiat dollar, it's going to become worth less and less in terms of gold, because gold is limited in supply. And that's what it's all about. They don't want gold going up in a straight line, because then, you know, everyone would be getting on it. So what they do, and they talked about this in the WikiLeaks documents from 1974, before gold was legalized, that they needed to have a futures market, very speculative, to keep people away from physical gold. So that's what they do. They keep gold speculative, and they keep it suppressed for a while, and then all of a sudden they let it go. But then most people by then will have lost patience. So patience is the most important thing, and it's a long-term thing. It's not for everyone. It has worked for me, and it has been frustrating at times. But yeah, patience is the most important thing. And I think, what's his name again? Mr. Tyler Cohen will be proven wrong, just like whoever wrote this for the FT was proven wrong. So there you go. With that, let's quickly look at the markets this morning. It's 8:35 a.m. London time. We've got spot gold at 1905. High's been 13 and the low has been 02. Silver's up 9 cents, 22.80. High's been 89, low has been 64. The Dow futures is down 15. The NASDAQ futures down 15 as well. S&P down 4. To the currencies, they look pretty much unchanged, really, with the exception of the dollar versus the yuan. That's a little higher, 725.17. Aussie dollar is up 0.25%, 66.20. The dollar is unchanged versus the loonie, 132.65. And the Kiwi dollar is up about 0.2 at 60.83. To the general commodities, WTI crude is down a third at 69.40. Brent is down a third as well, just below 74. Platinum is up $4, trading at 9.20. And high-grade copper is unchanged at 373.90. So we're going to finish off with the bond market. The 2-year gilt yield is up 11 basis points at 5.25. Yesterday it got up about above 5.30, and then it dropped quite a bit. Very volatile, and today is back up to 5.25. Let's check the Treasury market, U.S. Treasury market. The 2-year yield is up 5 basis points at 4.76, and the 10-year is pretty much stuck around 3 3/4. It's up 4 basis points though. So there you go. With that, I'm going to wish you all a very good day. Take care. Bye.